There are periods when systems fail loudly, and there are periods when they simply stop behaving as expected. The latter is more difficult to recognize because nothing appears broken. The mechanisms still function, transactions still clear, and institutional language remains calm. Yet beneath that surface, something subtle begins to drift. Relationships that once moved together start to separate. Responses that were once immediate become delayed or muted. The system continues to operate, but it does so with less coherence. Liquidity is one of the first areas where this dislocation appears, not as absence, but as hesitation. Capital still exists, but it moves differently. It pauses where it once flowed freely. Most participants do not notice this shift because it does not interrupt daily activity. Markets remain open. Credit is still available. Policy frameworks remain intact. The signals appear quietly, embedded in behavior rather than events. This is how liquidity disappears in modern systems, not through sudden withdrawal, but through conditionality. Access becomes selective. Movement becomes cautious. The system grows more rigid without appearing constrained. Quiet dislocation is uncomfortable because it lacks drama. It does not force attention. It requires observation. Those who rely on headlines or volatility miss it entirely. Liquidity, when abundant, is invisible. When it begins to thin, it does not announce itself. It simply stops behaving as it used to. That change is already underway. The present environment cannot be understood through comparison with recent cycles because the structure of the system has been fundamentally altered. Over time, repeated interventions have reshaped how stress is absorbed and distributed. What once triggered visible correction is now managed through layered mechanisms. These mechanisms have been effective at maintaining surface stability. They have prevented abrupt failures and smooth transitions, but effectiveness has come at the cost of resilience. Each intervention has extended balance sheets, increased dependency, and reduced tolerance for disruption. The system has become optimized for continuity rather than adaptation. Stability is preserved by design. Institutions operating within this framework behave differently. They become cautious, not because they expect collapse, but because they recognize limits. Policy decisions are framed as temporary, even when they persist. Adjustments are incremental, even when pressure is structural. Capital responds to this environment by recalibrating its priorities. Yield becomes secondary to liquidity. Duration shortens. Flexibility becomes more valuable than return. These shifts occur quietly, often dismissed as tactical. What makes this moment different is not the presence of stress, but the absence of release. Pressure is managed, deferred, and redistributed, but rarely resolved. Over time, this accumulation changes how liquidity functions. Liquidity becomes less about quantity and more about confidence. It flows not where opportunity is greatest, but where trust is strongest. This distinction matters. The system is no longer adjusting to shocks. It is adapting to strain. That adaptation alters behavior across institutions and markets, even when conditions appear calm. This is the context in which liquidity begins to disappear without vanishing. When systems come under prolonged strain, history rarely announces the shift through sudden collapse. Instead, it records long intervals where familiar structures remain intact, while their internal logic weakens. These intervals are often misunderstood because they feel stable. The signals that matter are not events, but changes in behavior. One recurring precedent appears in the late stages of dominant monetary regimes. In such periods, official frameworks continue to operate smoothly on paper, yet capital begins to behave defensively beneath the surface. Long-term commitments lose appeal, not because returns disappear, but because confidence and duration erodes. Institutions still promote stability, but capital quietly shortens its horizon. During these phases, liquidity does not contract visibly. Credit remains accessible, markets remain orderly, and policy credibility appears intact. However, access becomes increasingly conditional. Counterparty risk receives more scrutiny, balance sheet exposure is managed more tightly. The system still moves, but with less tolerance for surprise. Another historical signal emerges during extended credit expansions that outlast their productive phase. In these environments, leverage grows faster than productive capacity, and stability becomes increasingly dependent on confidence rather than fundamentals. Policymakers respond by reinforcing reassurance. Communication becomes more deliberate, emphasizing tools, coordination, and adaptability. This reassurance delays adjustment, but it also alters incentives. Capital responds not by exiting, but by repositioning. Liquidity preferences change. Instruments that promise flexibility gain favor over those that promise yield. These shifts are subtle and often framed as tactical, yet they reflect a deeper reassessment of system durability. A further precedent can be observed during periods of policy hesitation. These occur when authorities recognize structural limits but avoid explicit acknowledgement. Decisions are deferred, language becomes conditional, and interventions are framed as temporary even when permanence is implied. This hesitation does not trigger panic. Instead, it creates uncertainty without resolution. Liquidity reacts predictably to hesitation. It becomes cautious rather than scarce. Capital waits, deployment slows. The system enters a holding pattern sustained by coordination rather than conviction. Over time, this state becomes normalized. What links these historical moments is the absence of dramatic failure. Confidence erodes gradually, expressed through behavior rather than belief. Market participants may still accept official narratives, yet their actions reveal restraint. They hedge duration, they favor reversibility, they maintain optionality. Importantly, these periods are often misread in real time. Because institutions continue to function and interventions appear effective, observers assume stability has been restored. In reality, stability is being maintained through increasingly complex mechanisms. Liquidity fragmentation is a consistent outcome. Capital flows remain active but become uneven. Certain channels remain well-funded, while others quietly thin. The system appears liquid in aggregate while becoming brittle in practice. These historical patterns suggest that the most informative signals occur well before disruption. They emerge during the phase when confidence has not collapsed, but certainty has faded. That phase is characterized by quiet adjustment, behavioral caution, and selective liquidity. It is within this historical context that current conditions become more legible. The system is not failing, it is adapting under pressure. History suggests that such adaptation is never neutral. It reshapes how liquidity behaves long before outcomes become visible. The dominant signal underlying the current environment is liquidity strain driven by trust decay. This is not a shortage of money. It is a reassessment of reliability. Liquidity depends on confidence in institutions, counterparties, and frameworks. When that confidence is abundant, liquidity flows invisibly. When it becomes conditional, liquidity fragments. This fragmentation is subtle. Aggregate measures remain elevated, markets continue to function. Yet access becomes uneven, terms tighten quietly, participants become more selective. Monetary policy attempts to compensate for this shift by reinforcing confidence. Facilities are expanded, guarantees are emphasized, communication becomes more deliberate. These measures stabilize outcomes but do not restore trust. The misunderstanding arises because liquidity strain is often equated with crisis. In reality, it is a process. It unfolds gradually, expressed through behavior rather than disruption. Capital responds by prioritizing optionality. It seeks assets and structures that preserve flexibility. This response is rational and orderly, masking the underlying reassessment. Trust decay does not require disbelief. It only requires doubt. Doubt about durability, about policy effectiveness, about future flexibility. Liquidity reflects that doubt by becoming cautious. It remains present, but it no longer flows freely. That is the signal. Secondary signals reinforce this primary dynamic across markets. Bond behavior, for example, reflects a tension between safety and skepticism. Demand exists, but conviction is limited. Duration is approached cautiously. Currency markets reveal similar patterns. Movements are less about strength and more about resilience. Capital favors instruments that preserve mobility under uncertain conditions. Credit markets provide further confirmation. Access remains open, but standards tighten. Risk differentiation increases. Confidence becomes segmented. Metals and other tangible assets exhibit delayed response. They do not surge immediately because their role is not transactional. They serve as anchors when abstraction weakens. Together, these signals form a coherent picture. Capital is not exiting the system, it is repositioning within it. The consistency of these behaviors matters more than their magnitude. Across markets, liquidity is being rationed through trust. This alignment suggests a systemic shift rather than isolated adjustment. When monetary systems experience prolonged pressure, hard assets begin to behave differently, not immediately, and not in ways that attract widespread attention. Their response is often delayed, constrained, and at times deliberately muted. This delay is frequently misinterpreted as irrelevance, when in fact it reflects the structure of the system they operate within. Silver occupies a unique position in this environment. It functions simultaneously as a monetary metal and an industrial input, which places it at the intersection of financial confidence and economic activity. Under normal conditions, this dual role dampens its signal. During periods of systemic strain, however, the same duality causes silver to register pressure earlier than many assets, but less cleanly. Historically, when liquidity tightens and trust in monetary durability begins to erode, capital does not rush toward silver in visible waves. Instead, exposure increases indirectly. Inventory behavior changes. Settlement preferences shift. Demand manifests through reduced willingness to part with physical supply rather than aggressive accumulation. These changes occur quietly and are often dismissed as noise. Suppression is an imprecise but useful concept in this context. It does not imply a single controlling hand, but rather a convergence of incentives. Financialized markets prioritize order, stability, and predictability. Assets that reflect monetary stress challenge those priorities. As a result, mechanisms evolve that smooth volatility and delay repricing. This smoothing creates periods of apparent inactivity, prices remain contained, participation narrows. Commentary shifts toward alternative explanations, such as industrial cycles or substitution effects. Meanwhile, underlying availability becomes more rigid. The system appears calm, but flexibility is being lost. Delay is another defining characteristic. Hard assets often respond after pressure has already reshaped other parts of the system. This lag is not accidental. It reflects the hierarchy of confidence. As long as confidence in monetary instruments can be preserved through policy, liquidity, and narrative, hard assets remain secondary. The transition occurs when confidence management becomes insufficient. At that point, repricing is rarely gradual. It tends to be abrupt because it reflects accumulated adjustment rather than new information. Historically, this is when silver's behavior appears sudden, even though the underlying shift has been in progress for years. Importantly, silver does not lead these transitions through speculation. It responds through constraint. When liquidity is abundant, silver is easy to mobilize. When liquidity becomes conditional, silver becomes less available. This shift in availability is the true signal, not price movement. Hard assets more broadly follow similar dynamics. They become less responsive to financial engineering and more sensitive to physical flows. Leasing structures tighten, forward availability becomes less reliable. These developments rarely reach mainstream attention because they occur within specialized markets. What matters is not whether silver is moving, but why it sometimes does not. Periods of stability under strain indicate that pressure is being absorbed elsewhere. Eventually, absorption reaches its limit. When that limit is approached, the system does not announce the transition. Hard assets simply begin to behave differently. Liquidity ceases to dictate their dynamics. Constraint replaces abundance. This behavioral shift has repeated across monetary regimes. It is rarely recognized at the time. In hindsight, it appears obvious. Silver's role is not to predict outcomes, but to reflect the condition of trust within the system that prices it. When systemic pressure persists without resolution, the most revealing changes occur not in markets, but in behavior. Institutions rarely respond to prolonged strain with immediate acknowledgement. Their first instinct is preservation of confidence, because confidence itself functions as a stabilizing mechanism. As long as confidence can be maintained, structural adjustments can be delayed. Governments tend to frame stress as temporary deviation rather than structural shift. Language becomes carefully calibrated. Risks are acknowledged, but always in manageable terms. Emphasis is placed on resilience, tools, and coordination. This approach is not deceptive by design. It reflects the reality that public confidence is integral to system function. Central banks exhibit a parallel response. Policy decisions remain technically sound, yet increasingly constrained by second-order effects. Each action must account not only for its economic impact, but for its signal. Flexibility is emphasized. Optionality is preserved. Commitment becomes conditional. Over time, this conditionality alters expectations. Market participants learn to interpret not just policy actions, but hesitation. Delays, pauses, and qualifiers carry as much information as decisions themselves. The absence of clarity becomes a form of communication. Narrative management intensifies under these conditions. Official communication focuses on process rather than outcomes. Frameworks are reiterated. Stress scenarios are discussed abstractly. The goal is continuity, not resolution. This sustains stability, but it also normalizes strain. Investors respond by adapting psychologically. Long-term conviction weakens without disappearing. Capital becomes more tactical. Positions are structured for reversibility. Exposure is hedged not against specific outcomes, but against uncertainty itself. This behavioral shift does not imply loss of faith. It reflects recalibration. Participants continue to engage with the system, but with reduced tolerance for duration risk. The preference for liquidity increases, even when liquidity yields less. Safety is redefined as flexibility. Institutional investors, in particular, display this adaptation. Allocation decisions favor instruments that can be adjusted quickly. Balance sheet sensitivity to volatility increases. Stress testing becomes more conservative. And these changes are rarely publicized, yet they reshape market dynamics. Denial, when it appears, is subtle. It takes the form of overconfidence in mechanisms rather than dismissal of risk. Faith is placed in models, coordination, and historical precedent. Structural limits are acknowledged theoretically, but deferred practically. This creates a widening gap between narrative and behavior. Public messaging emphasizes stability, while private actions prioritize protection. This divergence is a critical signal. It indicates that confidence is being managed rather than organically sustained. Importantly, this phase can persist for extended periods. Systems do not require universal belief to function. They require sufficient belief. As long as participation continues, strain can be absorbed. However, prolonged confidence management carries cost. It reduces the system's ability to adapt organically. Adjustments become compressed. When change finally occurs, it tends to be abrupt, not because of panic, but because gradual options have been exhausted. The psychological response, therefore, is not fear, but fatigue. Institutions grow cautious. Investors grow selective. Narratives grow repetitive. The system continues, but with diminishing margin for error. Understanding this behavioral landscape is essential. It explains why visible calm can coexist with deep tension. It reveals why the most important signals are found not in what is said, but in how decisions are made under pressure. If liquidity strain persists, systems tend to undergo structural reordering. Volatility increases intermittently. Relationships recalibrate. Liquidity becomes episodic. Periods of calm alternate with tightening. Confidence becomes conditional. Institutions may consolidate control. Oversight expands. Flexibility contracts. These measures stabilize outcomes, but entrench fragility. Capital flows adjust. Credibility matters more. Domestic systems face pressure. These consequences unfold unevenly. There is no timetable. Persistence matters more than intensity. Liquidity does not disappear overnight. It withdraws quietly, conditionally, and selectively. That is what makes it difficult to recognize. The system is still functioning. That is precisely why these signals matter. They emerge before disruption. Awareness does not require action. It requires attention to behavior. Quiet dislocation is the system speaking softly, and systems rarely do so without reason.